Why is it important to control emotions of greed and fear while investing?
We have seen, smart people doing extremely stupid things by getting influenced by greed and fear. 80% I would like to allocate to behavioral aspect because even people with high IQ and very good understanding of businesses, valuations, portfolio construction, if they are not able to manage their emotions during market cycles, they will end up doing mistake, and which is very common.
Having a proper asset allocation framework for risk management. Why is it so effective?
So when there was an IT bubble in 2001, similarly during subprime bubble, the markets corrected by more than 55%. How do you ensure that you design a portfolio which is not as impacted by the market as the markets have been impacted? So asset allocation is a very beautiful way to manage the risk in the portfolio and also get higher returns in the long term. Most of the people go with static asset allocation of saying that 60% allocation to equity, 10% to gold and remaining to debt at all market levels. I don't think it's the right approach. We go with a dynamic asset allocation. What we do is, like, as we understand the market goes through peak and trough, the maximum P ratio goes to say around 30 plus when the market peaks, and it has bottom at 10. So there's a range we understand. What we understood that there's a cycle and there's a range through which we operate. Long-term P ratio for the market is at around 20-21. So the higher the markets are going above this long-term average, the more there is a downside risk and lower is the upside potential. So that means we should be reducing equity more the markets are going up.
Welcome to Truemoney Talks, our brand new podcast series on personal finance presented by Truemind Capital. In today's episode, we are going to talk about managing uncertainty in stock markets. We are going to talk a lot about controlling our emotions of greed and fear while investing. And to answer all the pertinent questions, I have with me Sumit Duseja, co-founder and CEO of Truemind Capital. Hi Sumit, welcome.
Hi Shivani, thanks again.
Our pleasure here completely. So Sumit, let me start this episode by asking you, greed and fear, they often drive investment decisions. Many a times, more than logic. Why is it important to control emotions of greed and fear while investing?
As Warren Buffett also says, it's not the high IQ, but how you manage your temperament in different market cycles, when everyone is going greedy and when everyone is going fearful. How you manage your emotions at that point in time, that determines your success with investments in the long term.
Many a times we are just inclined towards the more technical or fundamental aspects. We keep our eye on what is the sales growth of the company, what is the expected EPS of the company, the valuation attributes as you've been speaking about. We often forget about the growing field of behavioral finance and its importance.
Investment is something about understanding valuations, portfolio construction, but a major part also is about behavioral aspect, how you behave during different market cycles.
So what percentages would you want to allocate between, let's say, the behavioral finance aspect and non-behavioral finance aspect?
I would say 80% I would like to allocate to behavioral aspect because even people with high IQ and very good understanding of businesses, valuations, portfolio construction, if they are not able to manage their emotions during market cycles, they will end up doing mistake, and which is very common. We have seen, smart people doing extremely stupid things by getting influenced by greed and fear.
And that is the whole endeavor of having this episode also. Surely because of what you said, that 80% of your returns are going to come from how you can control your emotions while dealing in the stock markets. Okay, great. Moving on, Sumit, so our topic for today is managing uncertainty. Managing uncertainty is managing risk. And we have often hear you speaking about the importance of asset allocation, having a proper asset allocation framework for risk management. How exactly does it work and why is it so effective?
So asset allocation is a very beautiful way to manage the risk in the portfolio and also get higher returns in the long term. With asset allocation, based on your risk profile, we determine how much has to be in equity, how much has to be in debt, and how much has to be in gold. By having a clear roadmap of asset allocation during different stages of market cycle, we avoid making blunders by way of getting influenced from greed and fear. Asset allocation brings discipline to our investment decision making. And once we have discipline, we would be taking the right calls. We will be exiting from equity when everyone is greedy and everyone is complacent and the valuations are very high. On the other hand, we'll be adding to equity. We'll have courage to add to equity when everyone is fearful and the markets are low and available at low prices. That's the time when you should be over allocating to equity, not when everything appears good in equity, which most of the time, if you are not following an asset allocation, you will over allocate to equity and not over allocate to equity when the market's prices are low. That's why I said that without asset allocation, without discipline, you end up buying high and selling low.
So the essence of all this is that don't follow herding behavior. One should have an asset allocation framework and stick to it. But I believe that an asset allocation framework, it can't be one size fit all strategy. It has to be customized. We also spoke about the risk profiling part, that investors, they have different risk profiles. For example, someone could be a conservative investor, other one could be an aggressive investor. So how do you design a customized asset allocation framework for investors such as aggressive investor or an conservative investor?
Let me break down into different steps. First, it's important to invest in equity to at least preserve wealth and match your returns with inflation. So you cannot avoid equity. Equity market goes through cycles. The cycles of greed and fear, where the market peaks when there is an excessive greed and the valuations are very expensive at that point in time. And market bottoms when there is an extreme hopelessness, a lot of fear, and the valuations are very attractive at that point in time. So at high level, at the level of peaks, your downside risk is very high and your upside potential is limited. On the contrary, at the levels where the markets have crashed and bottomed, the downside risk is not much, whereas upside potential is significantly higher. Let me give you an example. So when there was an IT bubble in 2001, there was a lot of greed and complacency. Everyone was chasing tech stocks. And the market P ratio is a metric to understand the overall valuations of the market and to determine how expensive or cheaper the markets are compared to their long-term averages. So I'm using P ratio as one of the metrics to understand the valuation. So P ratio at that point in time when the IT bubble was there in 2001, it was at around 29-30 for Sensex. It crashed to 10 when the markets corrected and bottomed in 2003. Similarly, during subprime bubble, the P ratios were at around 28-29, almost similar levels that we saw in during IT bubble. And it crashed to again 10 P ratio. Both the times, the markets corrected by more than 55%. It's a significant correction that happened in the equity market. These kind of corrections happened many times in the past and will happen many times in future as well. How do you ensure that you design a portfolio which is not as impacted by the market as the markets have been impacted? That's where a customized portfolio is designed for different risk profiles. So for a conservative investor, our allocation towards equity would be in the range of, say, minimum 15-20% to maximum 40-45% across the market cycles. So we do not believe that your allocation should be static. For a very aggressive investor, our allocation would be 30-35% minimum in equity and 100% as well when the market levels are very low. So that kind of range between equity is maintained for different risk profiles.
So what I gather from you is that we should have an asset allocation framework. It should be a customized one and it should not be also static because market levels keep on shifting. It should be more like a dynamic approach is what I believe.
See, I certainly believe in dynamic asset allocation. Most of the people go with static asset allocation of saying that 60% allocation to equity, 10% to gold, and remaining to debt at all market levels. I don't think it's the right approach. We go with a dynamic asset allocation. What we do is, like, as we understand the market goes through peak and trough, the maximum P ratio goes to say around 30 plus when the market peaks, and it has bottom at 10. So there's a range we understand. What we understood that there's a cycle and there's a range through which we operate. Long-term P ratio for the market is at around 20-21. So the higher the markets are going above this long-term average, the more there is a downside risk and lower is the upside potential. So that means we should be reducing equity more the markets are going above their long-term average. On the other hand, when the markets are going below their long-term average, we need to increase equity gradually in the portfolio because we are adding equity at lower prices. So that's how our allocation will vary for different portfolios. For a conservative portfolio, it will go to as low equity as 15-20% when the P ratios have touched 30. And it will go as high as 40 to 50% when the P ratios have touched 10. So that's one of the best way to get higher returns and minimize risk in the portfolio.
My final question here would be, how many times changes should be done to this asset allocation?
See, I mean, a lot of changes in the portfolio frequently in a year would lead to many taxes and higher cost through exit loads. We, in a year, have been seeing portfolio intervention of about 3 to 4 times in a market which is not very volatile. When there's a lot of volatility, then it can go as high as 6 to 7 times.
And recently there's been a 10% market correction. Have you been changing your portfolios?
Just once we moved from debt to equity. Looking at, of course, the taxation impact on this. When we invest in equity, we like to keep it for more than a year so that we can minimize the taxes. And our approach is always long-term oriented. So the interventions are done very carefully as and when needed. It's not the action bias that we focus on. It's about whether it's needed or not and whether it makes sense after accounting for taxation and other expense ratio, exit ratio, etc.
When we have to rebalance our portfolios to align it back to our asset allocation strategy, in line with our asset allocation strategy, should we do like a lump sum transfer, or it should be a systematic transfer from, let's say, debt to equity or vice versa?
When a portfolio is actively managed between equity, debt and gold, one can feel free to allocate a lump sum also. Systematic way of investment obviously brings more discipline in adding to your portfolio on a regular basis. So when we design a systematic investment plan as well for our clients, it is not entirely into equity. It is mixed between equity, debt and gold with a long-term horizon in mind. And then given that we are actively reviewing the portfolio and allocation, we always redesign the portfolio, rebalance the portfolio based on the current market scenario and opportunities.
In understanding managing uncertainty, we have understood the importance of having a proper asset allocation framework. And we are also touching upon risk profiling a lot here. So I just wanted to ask any, interesting client stories with respect to the risk profiling decisions, something that they had in their mind beforehand. And after going through the whole risk profiling exercise at Truemind Capital, the outcome was somewhat different. Any interesting client stories from there?
There are many. What surprises me, a lot of people have no idea about the risk they are taking in their portfolio. Yes.
Okay.
What happens?
So what do they think? Are they having more risk or are they having less risk? What is their initial perception?
So they do not want risk. Everyone, wants to have no risk and very high returns, which of course, cannot happen. You have to come to a sweet spot where, you can have you're comfortable with certain level of risk, and you have to be comfortable with the returns that will come to you with that level of risk you are comfortable with. So we have seen many portfolios where, a risk profile turns out to be moderate, but the portfolio is 80-90% allocated to equity. We then have to explain them about what could be volatility in the portfolio, what has happened in the past, and that will happen in the future as well. So we have to make them understand about the risk in the portfolio and redesign the portfolio which matches with their risk profile.
Thank you so much, Sumit. So all these responses are pretty much helpful for us in managing uncertainty in the stock market. We touched upon more specifically on a quantitative framework, that is an asset allocation framework, very, very important to understand. We will continue this discussion in a future episode that will be part 2 of managing uncertainty in the stock market world, wherein we will touch on more qualitative aspects. Stay tuned and I'll see you soon. Thank you so much, Sumit, once again.
Thank you, Shivani. It's a pleasure.